Hello, everyone. I'm Arnold Gouren, and I'm research officer at Making Finance Work for Africa. So we are really glad to have you here. So I will go through some housekeeping rules, and I will present the agenda of the session. And after that, we will start. Please, next slide. Next slide. Thank you. So, no, before, please. The webinar will last 19 minutes, including question and answer. So all your microphones are disabled during the webinar, but you can submit your question via the Q&A slot. And the webinar will be held in English, and within 72 hours following the webinar, you will receive the slide, the presentation and the recording. And they will also be available on our website. And if you have any issue or a technical problem, please send a message to the organizers. And also, please do not forget to complete the questionnaire that you will receive at the end of the session. Thank you. So next slide, please. So today, first of all, we have an opening remark from Mrs. Eunice Kamwendo, that is Director of the ECA Sub-Regional Office for Southern Africa. After that, Mr. Alain Pasoko will present the main result, the key points, the key message from the report. And after that, we have the panel discussion. So, and we close the webinar. So I will now, next slide, please. I will now let the floor to Mrs. Eunice Kamwendo. The previous slide, please. So, Mrs. Eunice Kamwendo, the floor is yours. Thank you.
Thank you so much, Program Director. Can you hear me?
Yeah, we can hear you well.
You can hear me? Okay, good. Okay, no, thanks. Thank you again. And I'm just recognizing colleagues that are on the line, distinguished participants, esteemed colleagues, ladies and gentlemen. My task this afternoon or this morning is indeed a small one, but really looking forward to the conversation that we're going to have. So a good morning and good afternoon for some of us that are in Southern Africa to you all, and really a pleasure for me to have you join this very important webinar from across the globe. On behalf of the United Nations Economic Commission for Africa, ECA, and indeed on my own behalf, especially that the conversation that we're going to have is for Southern Africa, I'm truly honored to welcome you to this timely webinar on financial sector development in Southern Africa, organized collaboratively with Making Finance for Africa, Work for Africa, MFW4A, and the Economic Commission for Africa, of course. As you may already know, this webinar seeks to accomplish 3 interrelated objectives, and some of it, I think, the program director, Arnold, has walked through a bit of that. But I'll just go back into that is 1, to discuss opportunities and challenges that lie ahead in Southern Africa's financial journey, given the region's immense potential for growth, innovation, and rich tapestry of cultures and economies. It's also another objective is to provide a platform to explore the complex landscape of the Southern African financial ecosystem. Thirdly, would also be to engage in insightful discussions that are going to be led by our esteemed experts on financial inclusion, sustainable investments, and technology advancements that are reshaping the banking landscape. I'm really happy to see some of those experts that are online to be able to share their insights into the ecosystem. And for me, particularly, really a pleasure that this is happening in our backyard in Southern Africa, and really looking forward to seeing what those opportunities would be for the sub-region. Allow me to share a brief background on the African financial sector with a particular focus, of course, on Southern Africa. As you all know, and as experts, over the past few decades, Africa's financial landscape has undergone significant transformation, characterized by the development of robust financial institutions, enhanced regulatory frameworks, and technology advancements aimed at fostering economic growth and financial inclusion. Across the continent, we see a highly diverse financial sector with varying levels of development in different regions. Major financial hubs such as South Africa, Nigeria, Kenya, Egypt are leading the way and offering a mix of traditional banks, microfinance institutions, mobile money providers, and innovative fintech companies as well. However, while some countries boast robust banking sectors in Southern Africa, we do have giants and a few countries that are in this category: South Africa, Mauritius, Botswana, Namibia, and Zambia, to name a few, while others like Namibia and Eswatini are witnessing a growing prominence of non-bank financial institutions in the same way. And I think we do need a lot more that for financial deepening in Southern Africa. Despite the progress, the sector has faced numerous challenges, including limited access to financial services, high levels of informality, regulatory constraints, and economic and political instability in some cases, but also huge economic disparities and varying regulatory environments that pose significant obstacles to development across the region. Additionally, issues such as limited financial literacy, inadequate infrastructure, and persistent informality continue to hinder progress. However, these challenges also present opportunities, and I think we've learned so much, especially with the current shocks that we've seen, and how we can actually turn a lot of those challenges to opportunities. And I think by leveraging technology, we can enhance financial inclusion, and we've already begun to see a lot of that, especially with mobile money banking and other technologies. We can also tap into Africa's young and growing population and increase regional integration at the same time. Efforts to strengthen regulatory frameworks and ensure financial stability are ongoing, supported by national governments and international organizations alike. Policies are increasingly focusing on promoting financial inclusion, combating illicit financial flows, and fostering sustainable development. Regional integration and cooperation are key priorities, especially in the Southern African region through the Southern African Development Community. I think a lot of us know this, which consistently promotes regional financial integration with the aim of harmonizing a lot of the regulatory frameworks and enhancing cross-border financial activities. Initiatives like the SADC Integrated Regional Electronic Settlement System, CIRES, is one example of such, which facilitates cross-border payments within the region, fostering greater economic connectivity. And I think there are other instruments that are coming on board, of course, Africa-wide, that I think perhaps the Pan-African payment system would be another that hopefully can also build on what is happening at regional levels like ours. Financial inclusion and innovation are also at the forefront of our efforts in Southern Africa, with a strong emphasis on increasing access to financial services, particularly in rural and underserved areas. Mobile banking and fintech solutions are really playing an increasingly important role, with countries like Zimbabwe, Zambia, and Mozambique within the sub-region experiencing rapid adoption of mobile money services. And again, not leaving out some of the other countries, but just highlighting those three, because we've seen a lot of growth in those. In addition, there is a growing focus on sustainable investment driven by the need to address climate change and promote sustainable development. Financial institutions in the region are beginning to integrate environmental, social, and governance criteria into their investment decisions, reflecting commitment to long-term sustainability. Colleagues, ladies and gentlemen, the significance of the financial sector cannot be overemphasized. It is a critical enabler for creating the much needed stability to mobilizing domestic resources, mitigating currency risk, and fostering a stable environment for investment. By prioritizing the development of the financial sector, we are taking a proactive step towards insulating our economies from external shocks and creating a more resilient financial system. Moreover, the development of financial sector is paramount in our quest for economic transformation. These markets serve as a conduit for channeling savings into productive investments, facilitating the efficient allocation of capital, and ultimately driving economic development. And I cannot emphasize enough, I think all of us know this, especially because of COVID and others, we also see the challenges that we're having in terms of development financing, liquidity issues across the sub-region, and we have a lot of our countries here facing real challenges. And where we're sitting for ECA here, for example, in Zambia, you would have known the fact that the debt default and so on, and a lot more countries that are actually at risk of debt distress and so on in the region, which speaks to the issues of the criticality of having a more robust financial sector system. And the discussion therefore today, I think, will also help in trying to solve some of those larger macroeconomic issues that we're facing as a Southern African region. Colleagues, ladies and gentlemen, I will conclude by thanking our partners, Making Finance Work for Africa, for partnering with us in organizing this webinar. And as ECA, we are committed to an enhanced collaboration in supporting a strengthened financial landscape in the region and in Africa as a whole for inclusive industrialization, sustainable economic growth, and improved living conditions for the region and its people. Again, just emphasizing the challenges that we have in the Southern African region in terms of the large inequalities that we see, and those inequalities actually seep through even in our financial sectors that we see in the sub-region, with a few countries that are doing well and maybe not so much, and really underdeveloped in others as well. So the conversation today will be very, very important and critical to unpacking some of those issues and seeing really how can we harness and take advantage of the opportunities that we see. I wish you all an enriching and productive discussion, and again, looking forward to some of those insights by our experts in the meeting. And thank you again for your attention. I will hand over back to the program director. Thank you so much.
Thank you, Mrs. Kamwendo. Thank you for your remark. So I will now let the floor to Mr. Alain Pasoko. So next slide, please. That will present the key message from the report. Alain, the floor is yours.
Okay, thank you very much, Arnaud. First of all, I'd like to thank the Making Finance Work for Africa for giving the opportunity to present the financial sector regional profile for Southern Africa. And without any further delay, let's start with the economic and demographic landscape. Next slide, please. Okay, the Southern Africa region, which comprises 13 countries, had a population of 225 million inhabitants in 2022, with South Africa accounting for the largest share. According to the operational countries in the Southern African region are Guinea, Lesotho, Madagascar, Malawi, Mauritius, Mozambique, Namibia, Sao Tome and Principe, South Africa, Zambia, and Zimbabwe. Economic growth for the region is estimated at 2.2% in 2024, from 1.6% in 2023, a slowdown reflecting subdued growth in South Africa. The region also benefits from the spillover effect generated by South Africa for being the sole African country member of the BRICS, along with Brazil, Russia, India, and China, and also member of the G20. What can we say in terms of financial sector overview? We can say that the financial sector of Southern Africa countries is made up of different financial intermediaries, which include central banks, commercial banks, investment bank, pension funds, insurance companies, microfinance institutions, mobile money operators, as well as stock markets, just to cite a few of them. Although the level of financial development is different across countries, the financial system remains dominated by the banking sectors, except for countries like Namibia and Eswatini. For example, in Eswatini, the non-bank financial institution assets has reached 78% of the total asset for the financial system, according to the IMF. It is also worth noting that continued focus on implementing and strengthening the framework related to the anti-money laundering and countering the financing of terrorism remains critical in some countries in order to relieve pressures on corresponding banking regulation. Next slide, please. Okay, banking sector, structure and soundness. The banking sector in the Southern Africa present differences across countries. Banking sectors in Mauritius and South Africa are very sophisticated, with features that rival the international financial architecture, whereas in countries like Namibia and Botswana, banks are emerging with good record of accomplishments. However, in several Southern African countries, the banking sector remains narrow and underdeveloped. It is also worth noting that the regional banking sector's landscape remains diversified, with locally owned banks and subsidiaries of either Pan-African group or non-African foreign bank. The South Africa's banking sector is one of the most developed in the region. Many banks headquartered in South Africa do their business in various countries in the region and the continent as well. Another point is that the banking landscape also remains relatively concentrated in the region. For example, the banking asset concentration as a share of total commercial bank asset stood at 100% or nearly 100% in 2021 for the three largest commercial banks in Lesotho, Malawi, and Namibia. This high concentration of banking sector remains an obstacle to financial inclusion in the region due to low competition and the high cost of credit, which result in low base credit access rates for household and small and medium-sized enterprises, SMEs. This is evidenced by the low level of bank credit to private sector recorded in the region, which was far well below the average of 26.7% of GDP in 2022 for sub-Saharan Africa. Overall, the banking sectors across the region have demonstrated a high level of resilience by maintaining sizable capital buffer because of the policies put in place by central banks to mitigate the financial stability risks associated with the emergence of the COVID-19. In terms of asset quality, the deterioration of asset quality in the banking sector as measured by the ratio of non-performing loans, NPLs, remains a problematic situation in the region, and this can generally be explained by the prevalence of high-cost insecure lending and the continuous economic impact of increased inflation rates induced by geopolitical insecurity combined with higher interest rates. For example, in countries like Angola, Eswatini, Madagascar, Mozambique, and Sao Tome and Principe, non-performing loan remains above the acceptable limit of 5% in 2022 and 2023, reflecting the need to intensify efforts to achieve a bearable low level of NPLs. In terms of capital adequacy, liquidity trends, and profitability, we can say that the banking industry in countries across the region remains solvent with adequate capital and capital adequacy ratio complying with the indicated regulatory standards for many of the countries. The banking liquidity remains also sufficient as countries' banking industry comply with the minimum liquid asset ratio requirements. Banking profitability as measured by the average return on asset and the return on equity has increased in most countries between 2021 and 2022. So in terms now of challenges in the banking sector, we can say that there is a strong interconnection between the banking system and the non-bank financial institution, which can lead to a risk of contagion in the regional financial system. And this situation can be explained by the fact that in some countries, loans to non-financial businesses and households are the biggest contributors to NPLs, and also non-bank financial institutions, which account for an important share of banks' deposits, are closely linked to foreign markets. This situation can trigger significant pressure on banks in the event of portfolio adjustment by institutional investor or non-bank financial institution. Another challenge is that banks' balance sheets show high exposure to government. The growth of banks' assets was mainly in less risky assets, such as government and central bank securities. This confers a certain vulnerability to banks in case of deterioration of a country's fiscal metrics. This greater bank's appetite for safer government bonds also leads to a crowding out effect of credit to the private sector. Remember, the low level of bank credit to the private sector recorded in the region, which is well below the average of 26.7% of GDP in 2022 for sub-Saharan Africa. Next slide, please. Next slide, please. Okay, capital market depth and challenges. The Southern African region has 9 stock exchanges, and the Johannesburg Stock Exchange is the leading stock exchange in the region and the world continent as well, with a market capitalization representing 313% of GDP in 2023 against 51.9% and 18.6% of GDP for Mauritius and Namibia, respectively. What we can keep in mind is that market capitalization remains very low in most Southern African countries. Stock markets in the region have a low turnover ratio, suggesting a low level of liquidity. For example, the turnover velocity as a proportion of the market capitalization for Botswana, Mauritius, Namibia, and Zambia stood at 8.4%, 3%, 1.3%, and 0.6% respectively, which is far below that of South Africa, 25.9%. Most of the stock market in the region face relatively high fixed cost and low trade volume, a situation that can prevent market from operating more efficiently. Compared to South Africa, the breadth of stock market in the region, which can be captured by the number of listed companies, remains also limited, highlighting a relatively small number of stock for investors to have a more diversified portfolio, which is necessary for risk mitigation. For example, in 2023, the total number of listed companies in Botswana, Namibia, and Mauritius reached 31, 49, and 96 respectively, far below 284 for South Africa. It is worth noting that the region is also characterized by a small number of listed foreign companies, suggesting relatively limited cross-border or inbound listings in the region. IPO's activities in the region remain sluggish over the past 10 years. For example, over 2011 and 2021, countries like Zambia, Mozambique, Malawi recorded respectively only 1, 2, and 3 IPOs with 9, 64, and 67 million of US dollar as raised capital. In terms of fixed income market and debt, we can say that private bonds tend to dominate the bond landscape in terms of number, but the proportion of government bonds in nominal value remain high. For example, in Botswana, the proportion of government bonds as in nominal value has reached 74.7%. In terms of sustainability-focused products, we can say that central banks and regulators in the region have been very active in developing green bond markets. Initiatives that have been undertaken in the view to developing green bond market include strengthening of the legal and regulatory framework, including national green bond guideline and governance, as well as issuing benchmark sovereign green bonds. Stock markets in countries like Botswana and South Africa have annual sustainability reports, as well as written guidance on environmental, social, and governance, ESG, and also ESG training provided to investors. However, most of the countries in the region have relatively performed little in terms of ESG consideration, although effort to produce guidelines for sustainable and green bonds as financial products could be mentioned for some of them. Various barriers and constraints stand against the development of the green finance in the region. Among others, we can cite the lack of bankable projects which could be financed with green bonds. In terms of investor base, a key constraint which limits accelerated deepening of the domestic capital markets in many Southern African countries is the shallow investor base, largely reflecting the low level of domestic saving, as well as the relatively low income level. Some countries in the region have adopted reforms that cause institutional investors to play a significant role in local investment because of the importance of assets they manage. Next slide, please. Next slide. Okay, pension industry. As an overview of this industry, we can say that countries in Southern African region show different pension scheme patterns, which are based upon either a pay-as-you-go defined benefit or a defined contribution provident fund. Pension funds penetration, as measured by the ratio of its asset to GDP, remain low in most of the countries in the region. For example, pension fund assets in Angola, Zambia, and Zimbabwe remain paltry at only 1.5%, 2.8%, and 5.8% of GDP, respectively, in 2022, which is very low when compared to countries like Namibia, South Africa, and Botswana, which show a relatively high penetration rate, 89.3% and 30.5% and 50.1% in 2022, respectively for those countries. It is also worth noting that the high penetration ratios achieved by these countries could result from the government pension fund good investment return based on diversified investment strategies coupled with a strong asset allocation process. In addition to that, investment in domestic equities with long-term growth prospects are promoted through higher allowable investment limit. For example, in South Africa and Namibia, investment limit in equities stand at 54% and 75% respectively. And in countries like Namibia, we have a regulation which is called Regulation 13, which by specifying investment limit applicable across asset classes, compels pension funds to hold at least 45% of contractual savings locally. One of the biggest challenges in the industry are important deficits recorded by some large public pension funds, which are undermining the financial stability of the sector. Also, low-scale level of fund administration, late payment of member benefits, and excessive administration spending at the expense of investment are counted among the impediments to the development of the sector. Another major issue governments across the region are facing is that most of the working population remain uncovered, being predominantly informally employed. Next slide, please. Next slide, please. Financial inclusion. In terms of financial inclusion, we can say that Southern African countries have performed well between 2011 and 2022, as shown in the table, when it comes to financial inclusion. Except for 3 countries like Malawi, Mozambique, and Zambia, the majority of countries throughout the region report a level of financial inclusion above the sub-Saharan average of 55% in 2021. Mauritius and South Africa, whose level of financial inclusion stood at 90.5% and 85.3% in 2021, compares well with a lot of emerging countries. And this progress is partly attributable to rapid adoption of digital financial services, including mobile money, driven by the implementation of the agent model and the steady growth in point-of-sale terminals. National financial inclusion strategies have been adopted by countries in the region to improve access to formal financial services, but for most of them, these strategies, which have come to an end, present a mixed record and obstacle to overcome in order to fill the gaps. One of the first obstacles to deal with is the low level of income that hinders access to formal financial services. In addition to that, we have the lack of knowledge of financial products and the poor understanding of how they work, especially those products related to the insurance industry. Talking about this industry, high cost, especially for insurance products, would also be a barrier to inclusion. Irregular income due to the preponderance of informal activities makes some households unable to meet the minimum account opening requirement and much less the more stringent know your customer requirement. Next slide, please. So we now go to the SME finance. And we can say that talking about the SME finance, that the contribution of small and medium-sized enterprises is very important in the Southern African countries. For example, in South Africa, SMEs account for about 91% of formal business entities and contribute to about 57% of the GDP and provide nearly 60% of employment. Despite this, SMEs' business model in the region remain unsustainable. The main situation is largely attributed to the fact that most SMEs are financially constrained in the majority of Southern African countries. Countries like Eswatini, Angola, and Madagascar show the largest SMEs financial gap, representing 45%, 33%, and 27% of GDP respectively. Factors that hamper SMEs' access to finance in the region are manifold. These include lack of corporate governance skills, weak financial government skills, especially with regard to risk management and high collateral requirements, which usually relate to real estate such as land and buildings. Most SMEs in the region evolve in sectors that are either informal, with undocumented assets, or with highly volatile production and small value added, such as agriculture. For these SMEs, the prospect for profitability, which would highlight their ability to repay, are not very promising. Another challenge is the burdensome bureaucracy, which leads many firms to operate in the informal sector, reducing thus their eligibility for bank credit. Next slide, please. So what can we say in terms of recommendation to the financial sector? Next slide, please. So for the banking sector, the high level of non-performing loans in the region requires a close monitoring of the banking sector. Central banks should intensify the supervisory action to ensure that banks achieve a sustainable reduction of high level of NPLs. Government should also increase the fiscal space by increasing government revenue through diversification of the tax base and simplification of the tax system to reduce the exposure of banks to sovereign risk. Effective regulation across the banking system, as well as the proper governance and accountability structure, could moderate the risk of increasing interconnectedness between the banking sector and the non-bank financial institution. For the capital market, in the light of high fixed cost and low trade volume that prevail in most stock markets, bringing listing fees and transaction costs down to levels that are very competitive could lift those constraints and enable the market to operate more efficiently. A deeper pool of issuers is also required for the acceleration of green bond growth in the region, especially among corporate borrowers. Hurdles such as lack of relevant technical expertise among market participants and institutional capacity constraints should be prioritized by the development of the green bond in the region. The domestic bond market should be deepened. This will require a coordinated approach from the public and the private issuers, including issuance of the longer benchmark maturity for government debt securities. For the pension sectors, reforms should be undertaken to enhance skills in fund administration. Arrears should be thoroughly dealt with as they constitute an exacerbating factor of poverty, which could result in a drop of the already low contribution rate and thus weakening the financial stability of the sector. And as the population is predominantly informally employed, there is also a need for regulators to design convenient, affordable, and inclusive solutions, such as micro-pension products, which could be facilitated by the relatively high rate of mobile penetration in the country. In terms of financial inclusion, the financial inclusion could take advantage of the financial education program implemented with a roadmap at the country and regional level. Authorities should enhance the competition in the banking system through the promotion of new players, especially those that help to improve financial inclusion. Helping the small and medium-sized enterprises develop bankable business plan and streamlining government support program toward them could be done through the implementation of a private-public partnership with the aim to boost their activities in the major term. Thank you very much for your attention. So I give the floor to Arno, please. Arno, you have the floor. Thank you very much.
Thank you, Ale. Thank you for this presentation. So now I will ask the panelists, if you see a question in the Q&A slot and you have the response, you can respond directly. And for the audience, if you have any question related to this presentation, you have to keep it to wait for the Q&A session to answer it. But you can write your question now. So I will now leave the floor to Dr. Elizabeth Nanziri, that will moderate the panel. So Elizabeth, you have the floor. Thank you.
Bonjour à tous. Good morning and good afternoon, depending on where you are. It is a great pleasure to have you all join this webinar as we discuss the Southern African financial sector profile prepared by the Making Finance Work for Africa. So thank you so much, Alain, for such a comprehensive presentation. And to help us discuss the findings of the report, we are honored to have as our panelists, Ms. Punki Modise, the Chief Strategy and Sustainability Officer at ABSA Group, Andrew Bamuje, Senior Investment Manager, SME at the Trade and Development Bank, and Bernard Ayen, who is an actuary and Managing Director of Aon Solutions Limited in Mauritius. I will request these panelists, of course, to tell us more about themselves, because I definitely have not done justice to them. However, I know that these panelists have a great wealth of experience in their respective constituencies, and I invite you all to read their bios over and above what they're going to discuss or to tell us now. Before I proceed, may I please call upon, my panelists to, give you a little bit of an intro about themselves. If you don't hear more or to learn more about them, you can read the bios. So may I call upon Ms. Punki Modise? Please could you say something about yourself before we proceed? Thank you.
Thanks for having me, Elizabeth, and good afternoon to everyone. I'm actually based in South Africa, but for those that are yet in the morning, so good morning to all of you. From my side, I'm with the ABSA Group. I've been with the bank since 2008. I'm now leading the strategy and the sustainability office within the bank. I've been doing this now for 18 months. So thanks a lot.
Thank you, Punki. Andrew Bamuje, could you please come in? A brief about yourself. Thank you.
Good afternoon. Thank you, Dr. Naziri. My name is Andrew Bemuje. I work with the Trade and Development Bank Group, in particular the Trade and Development Fund, the concessional lending window of the bank. And we do SME, small and medium enterprise investments of up to $10 million across the Eastern and Southern African region. Pleased to be here.
Well, thank you so much, Andrew. Bernard.
Yeah, good afternoon or good morning to everyone. I'm very pleased to be on this panel. I'm an actuary working in Africa now for nearly 24 years. Before then, I was working in Europe, in England, and in Belgium. So I'm really sort of a pension specialist, but of course, I keep an eye out on insurance and other matters and financial services. I have clients in mainly the Southern African region, countries like South Africa, Lesotho, Malawi, Eswatini, and Zambia. Yeah, Botswana as well. Thank you.
Thank you very much, Bernard. So I believe everybody will agree with me that we do have expertise on the call to at least help us dissect the key elements of the report. Okay, so may I just remind you once again to put your questions in the Q&A tab on your screen, and we will attend to them during the Q&A session. Yes, to help us, maybe we'll start off with the banking industry. We have had quite a lot. The report shows that the region's banks hold a large proportion of outstanding national sovereign bonds, and this has a few implications. For instance, so this bank's appetite for safer government assets has the potential of crowding out of private credit, especially in the region. So I'm asking Punke, what could be the policies to better promote banks lending to the private sector in such a context? And how do you as banks manage this exposure to sovereign risk?
Yeah, thanks a lot, I think, for that question, Elizabeth. I think earlier on, Eunice, in her opening remarks, she actually reminded me, of the old saying that Africa is not a country. So my sense is Africa as a whole is not particularly highly indebted, nor unindebted, at the same time. I think if you look at the picture, across the continent, it differs somewhat, with some countries having relatively high debt to GDP levels and some having relatively low levels of, debt to GDP. However, I think that said, some of the very big markets, including Ghana, Kenya, and Egypt, have clearly run fiscally unsustainable debt strategies. In my view is, I think, therefore, as they emerge, I think, from the IMF mandated programs, there are new opportunities also, in the horizon. In particular, it highlights that it may be better for banks to lend directly to strong private sector firms. And this, to a greater extent, requires project preparation and partnership with borrowers throughout the project financing life cycle. If you look at it, I think from you have to look at it, I think, from pre-feasibility stage all the way right through to bankability and construction. So therefore, this means that banks operating in the continent have to have more end-to-end, approach to risk management, and they have to be thinking about bankability, in its fullest form. Thanks, Elizabeth.
Thank you so much. I hear a diversified Africa, and therefore strategies will have to be country-specific. Thank you very much. Andrew, you're our expert on SMEs. SMEs continue to grow, and their role definitely expanding. For instance, we've had in the reports by Alain that in South Africa, for instance, SMEs account for 91% of formal business entities. That's quite a lot, contributing about 60 or 57% to GDP and providing nearly 60% of employment. And figures for other countries such as Zimbabwe are about 60% of GDP. Madagascar, they account for about 29% of added value and 31% of job creation. So, Andrew, the report finds a high concentration of the banking sector, and this is an obstacle to bank credit access in the region, especially for these SMEs. What could be the policies to better cope with this barrier and promote financial inclusion for SMEs?
Thank you, Dr. Nanziri. I'll speak from a development finance point of view. And the benefit we have as a regional development finance institution, which is self-regulated. We do have the opportunity to deal with these issues from a blended finance perspective, working with partners, collaborating, and like the previous speaker mentioned, trying to pursue an end-to-end approach through our blended finance structures. So what we've done is tried as much as possible to combine our risk capital with concessionality in many ways, including price, including tenor, and other softer terms, especially when it comes to women. We have structures that help to include women and youth into our borrowing structures through concessionality, but as well looking for instruments that enable us to circumvent the challenges that small and medium enterprises are facing. We've been able to do unfunded guarantees in Zimbabwe, in Burundi, and that helps us leverage our balance sheet, our capacities as a regional player to unlock local liquidity that effectively answers some of the challenges that the SMEs are facing. So if you take the Zimbabwe example, it's a difficult market at the moment. And if the player is looking for local liquidity, at the time we issued a guarantee, we're able to leverage our structures to unlock local liquidity through an unfunded guarantee. So in that case, we're looking to use instruments that solve problems that speak to the context of a specific market. And again, we then blend with technical assistance and capacity building to support the bankability and post-bankability of these SMEs. If time allows, we're able to share an example later on, but I believe that we have the options to be innovative and creative to solve the challenges of SMEs being included. Thank you.
Absolutely. Of course, as you said, that if time allows us, I think we'll come back to you and talking about the timing of the financing, knowing that majority of the SMEs failed within the past 18 months. But let's pack that for now, and we'll come back to it. Let's just quickly look at the pension, the pension industry, which is another key area. Mr. Yan, pension funds provide an alternative source of funding that perhaps governments can tap into for their development objectives. Despite the development of pension funds that Alain has talked of in the region, we can see that the proportion of people with at least one social security benefit is still low, in most of the countries in the region. So based on your experience, how could the countries in the region improve the take-up of pension funds products?
So one of the things that I think comes to mind, and it's been already mentioned, in the region we have a high level of informal. The informal sector is quite high, is quite big. So unfortunately, my work as a pension fund advisor tends to concentrate on the formal employment sector. So in a way, pension funds, they are long-term investment institutions. And unfortunately, human nature is such that we don't want to think about the uncertain future. If you have a certain amount of money coming in every month for your salary, I think that I mean, my experience is that if you don't force the people to contribute or to save money, they will not do it by themselves. And so that's why pension funds growth in the region has mainly been through compulsion, not voluntary. If you work for the government, you have to be in a pension scheme, basically. That's tends to be well covered. If you work in the private sector, and especially in the informal sector, there is not a lot of structures. If you in the formal employment sector, typically you will have some countries that have a good history of savings, but then you once you depart from the formal sector, there's a large group of people in the informal sector that do not save for themselves or are not forced to save for themselves, and they do not save for themselves. So that's one of the challenges, I think. So my answer is, how do we get more informal sector, people in the informal sector participate or set up or participate in multi-employer pension funds, for example, which are available in many countries. Yeah.
I think another person would ask, how about getting them the products that can find them in their informality? Indeed, the informality on the continent has been a challenge for access to or making access to finance work. So maybe thinking about the products to reach them where they are, as opposed to maybe getting them into the formal sector. We can think about that. And also, in some cases, we've heard about arguments of a paternalistic approach, forcing individuals to save, which is perhaps the right way to go, but perhaps striking a balance between not necessarily being accused of that paternalistic approach towards individuals that ultimately should know better about how to plan for their future. Thank you so much for that, Bernard. Let's talk maybe about sustainability. Yeah, desperate times of climate change especially calls for desperate measures. So in view of this need for green climate change adaptation and mitigation financing needs in Africa in general and Southern Africa in particular, asking Punke, what is Absa's strategy for making more ESG financing available? Can we maybe have some case studies?
Yeah, no, thanks a lot for that question. I think maybe the best place to start is just by looking at the global landscape, before I get into Absa's strategy. And I think if you look at the global, landscape, I think in contrast to other jurisdictions, the continent will need to rely heavily on banks, for ESG funding. And this is because, capital markets are relatively underdeveloped and quite illiquid. So capital markets in the region, have a low turnover ratio, which suggests also a low level of liquidity. So if you look, case in point, in 2022, I think the turnover ratio for Botswana, Mauritius, and Namibia, stood at 0.3%, 2.8%, as well as 1.7%, respectively, which is far below that of, South Africa at about 27% or so, give or take. So I think then most foreign investors and asset managers, have also indicated that their investment universe is defined by benchmark indices for their asset class, as well as country selection. Particularly, I think if you look at the JP Morgan government bond index for emerging markets, it consists of regularly traded fixed rate and domestic currency government bonds, which international investors can readily access. And the index, includes countries where local market investing is subject to explicit capital controls, but eligibility considerations, do not factor in, I think, regulatory as well as, some of the tax hurdles. So if you just look at that, it starts to clearly demonstrate, that, the banks in the continent will have to, play equal role, in sustainability and in ensuring that the continent transitions, I think, in the most appropriate way. So to that effect, if I turn on to, our strategy as an organization, I think we've been quite clear that, first of all, you can't transition in the continent without adopting just transition, as a mechanism to help with the transition, particularly in the context of the fact that, there's a lot of, I would say, capacity building that's going to be required, in the transition. And that means that, some of the industries that we currently have, particularly those that are dependent on coal at this point in time, we're going to see those industries, disappear, over time, or playing a much more reduced role over time, which means that the jobs that are in that space, are going to be lost in the process. So we've got to find then mechanisms of how do we reskill and ensure that we protect, I think, those jobs as we go forward. So I think if you look at it, therefore, in that context, as a bank, we're quite clear that we play a central role in the socio-economic development, throughout the continent, particularly because we are a Pan-African bank. So we can therefore not neglect the fact that, the people of the continent still need to, survive, today in order for them to transition. So it is within that context that we think significantly around, transition. And if you therefore look at, the areas where we play significant role is we play a role in advisory services by providing expertise, on how to help companies to develop, viable, sustainable, green projects. But also, in the technical assistance space, we also play quite a role in offering technical assistance and then capacity building initiatives and workshops to enhance the ability, I think, of businesses to create and present ultimately bankable, projects. And I think the other aspect, maybe just to pull out, is the fact that, from an innovation point of view, we also run innovation immersions, from time to time, with a view to, establishing and foster, I think, collaboration between stakeholders to develop innovative green financing solutions. So those are some of the things that, as an organization, we play a core part in. But I think maybe the one other aspect which is also important here is just about, how we approach reporting and how transparent, I think, we've become in terms of, how we talk about our efforts. And it's more from a point of view that I personally strongly believe that, sustainability, you can't force it on people, but you've got to nurture it. And the only way to nurture sustainability is by ensuring that you walk the path, with communities, with, key industry players, but also at the same time, the organization itself has to transition in the right way. Thanks, Elizabeth.
Well, thank you very much. And when you started off by saying that companies have to rely on banks for ESG financing, yes, what came to my mind was the issue of bankable projects that Elaine mentioned as part of the report's findings. And yes, my question was going to go to that. And you have quickly, yes, given us some tips on how at least you helping companies, because the issue of skills is critical. It's critical in pretty much every space. Talk about even the pension industry as well. And green financing is new, well, relatively new, but we've had challenges that have existed in as far as accessing bank finance is concerned. So we're glad that you're doing something around skills or skills development from all areas, including reporting. Yes, so thank you so much for that. And I also had, yes, just transition as a way to go or where to start from. Thank you for that, and I'm looking forward to comments so far in that regard. I'll pick them up as we go ahead. Andrew, I promised to come back to you regarding, SMEs and the fact that they tend to die away quite quickly, as soon as they're established. So they struggle to survive. Failure rates of about 70 to 80% in the first 18 months, attributable obviously to financial constraints. At least 66% in Malawi report failure due to financial constraints. And in other countries like Zimbabwe, Mozambique, this figure is high. Yeah, in this era of sustainable financing, what initiatives does the bank have, or does the bank take to improve access to green financing for SMEs? If we can start talking about green financing for SMEs.
Thank you. Thank you, Doctor. What we've done with this growth enterprises, we've been able to categorize these enterprises, and we focused on what we call the missing middle SME. Mm-hmm. The missing middle SME is exactly in the category that you've just referred to. So we're not necessarily focused on the very lower end, which maybe the microfinance institutions can serve. But again, we're not focused on the higher level where TDB, the bigger bank, can serve, or the commercial banks can play. So we focus on the missing middle that cannot be serviced by the lower tier, at the same time cannot be serviced by the commercial banks. And what we're doing there, I'll take an example of what we're doing in Kampala this week. So we're meeting 2 small and medium enterprises that are in need of growth capital, but from our initial assessment of screening, will not be able to access that capital from a Standard Chartered or ABSA, are not yet there, but we can help them prepare for that next level and become suitable to crowd in the bigger banks or the bigger commercial banks. In doing so, we are structured to avail services in-house for environmental and social and governance capabilities for pre-bankability. And we have in-house specialists who work on these projects all the time. So as we go out to do due diligence, we then travel or bring on our deal teams, specialists in this area, who help us do the environmental and social due diligence, help prepare a gap analysis, and prepare support through empowered local consultants that TDB or TDF brings on board in each of these markets. So first of all, for projects that would then not be bankable, we've already supported them with the element of green. We're enabling capacity or knowledge transfer, helping them understand the why of this has to be done and why it's important for their businesses to grow. But we also carry the cost, or we cost share the element of consultancy fees to be able to do this. And by doing that, we then come out with a rounded transaction that is able to be bankable and disbursable. However, we'll leave behind that knowledge with the SME. So post-transaction, this SME is able to carry on with this ethos of ESG in their day-to-day workings and throughout the reporting for the transaction, that we believe that at the next phase of borrowing, it's easier for them, but embedded in their day-to-day operations, they're able to see green and do green on a day-to-day basis. Thank you.
Thank you very much, Andrew, for this. I'm going to request the audience to prepare your questions as I speak, as we take this question for Bernard. After Bernard's question or answer, I would request, or at least I'll give a moment to the audience to ask a few questions. Bernard, let me come back quickly to you here and talking about, again, these pensions. that alternative assets still represent a very small proportion of pension funds assets under management in Africa and the region. What explains this trend or pattern, and how can these proportions be improved? Bernard.
Okay, yeah, so one of the first things I've noticed is that in many countries, government bonds sort of crowding out the rest of the investment strategy because, you know, government bonds are loans to governments. So and if the rates, the yields are high, which is true in many cases in local currency, it does seem it will become easier for pension fund trustees, pension fund managers to allocate a high proportion of the money to be invested in those bonds because they are supposed, in theory, to be less risky than, say, equities or the stock market. So I don't know what the answer is to that, but I think that in some cases, it seems to me that the capital markets are not developed enough to be able to control or to balance out those risks. So that's why a high proportion goes to government bonds. Sometimes it's due to the investment restrictions actually imposed by the government or by the country itself. Alternative investments do offer diversification, do offer potentially higher returns. I'm thinking also of foreign investments. So many countries have restrictions on how much to invest abroad or outside the country. In my view, it would be better not to have so many restrictions and leave the pension fund trustees or managers to look for the best returns and maybe to diversify away from the country, the local country. I saw a question in the Q&A. Somebody actually asked, will there come a time when pension fund administrators and asset managers make available a portion of these funds to SMEs to finance their capital needs? It's very, very common question because pension funds should allocate a proportion to alternative investments such as private equity. So this is in the range of private equity. But of course, unfortunately, you cannot expect pension fund trustees with responsibilities to invest widely to have the time or the energy to investigate SMEs and decide to allocate their money. I think the banking sector is probably better placed to assess these risks and lend them money. But of course, there is a space at some point where an SME becomes more medium-sized to encourage them to list or to encourage them to be on a, let's say, a development listing of some sort with financial incentives. I think that could work. But really to jump to the big pension funds, it would be a high. It would be difficult to access finance through pension funds for these SMEs. Yeah.
Right. And I do agree. We do not want to utilize our pension funds, for projects that are not necessarily going to give us returns. I mean, we don't want the population to turn against you as asset managers. Thank you very much for that. Ms. Punke, there's a question for you that I would like to draw your attention to. I'm not sure if you have seen it in the chat. Otherwise, it's talking about risk management. Any thoughts about the state of the holding environment for finance in Southern Africa? This is a question from Emmanuel. Not sure if you have seen it. It's pretty much at the top, at the bottom. Did you see it, or must I read it all?
Yeah, if you can just pick up the question for me, I'll appreciate.
Okay, so they're asking, this is in terms of risk management. Any thoughts about the state of the holding environment for finance in Southern Africa? Can the panelists share the thoughts on opportunities for engagement with governments to develop economic codes, related regulatory and licensing systems, and further alternative dispute resolution mechanisms that can build a better enabling and investment climate for both national, regional, and international organizations for the region. Quite a mouthful, but I'm not sure what you took out of it.
Yeah, no, thanks a lot. I think that's a great question, Elizabeth. My sense is, it's always better, I think, to have the private sector, play a key role when it comes to, lending, in particular, particularly given that, in this space, you do require an element of, agility. So in my view is you want the government to play their core part in creating an enabling environment. So the policy framework should be set up in such a way that enables, effective competition, I think, to play out. And then I think when it comes to issues of, risk management, I think the banks have done risk management for an extended period of time, and they've got a better sense of, that end-to-end value chain and how to make it work in an effective way. And particularly so, I think it becomes important now than ever before when you're sitting in a space where interest rates, I think, are going to be higher for longer. So banks sit with a lot of data, that helps them to make quick decisions. And I think the one positive also is the fact that, we're now moving more into a space where we've got artificial intelligence really helping to scale, the outcomes fairly quickly from a credit lending perspective. So in my view is it is going to be more and more important, I think, for governments to continue to create an enabling landscape, because also clients know that, for them, to get better outcomes, they have to go to their banks. And if the landscape is enabling, banks are able to play also their part. And I think you also see it play out, especially in the renewables space, with the transition to greener energy solutions. I think banks have really enabled, particularly if you look at, South Africa, from a South Africa point of view, I think we've got limited infrastructural capacity, to connect, I think, renewable energy to the grid, alongside to existing some of the electricity generation shortfalls. And when you look at the role that the banks have played of that of an intermediary between all of these corpus, they've really enabled that value chain, to work effectively. So those are some, I think, of maybe the points I can offer at this point in time as far as that question is concerned. Thanks.
Thank you very much. And okay, I'll take this question before we come back to you. There's another question from Abdullah. This is in regards with, again, ESG bonds, making them tax-free. But you can think about that while we pick up questions on financial inclusion, perhaps. Andrew, if you are able to come in here, you can. We have a couple of questions in terms of financial inclusion. If there's a synergy within the zone to improve financial inclusion, that is, I think, within the region. And another question, again, to do with financial inclusion, the impact of finance and open banking on financial inclusion, and then also on fintech. Andrew, if you can, please come in, and maybe I can throw in a word or two after you.
Sure. Thank you. Let me use the example of fintech, and I'll use a case that we're working on at the moment without sharing names, because we're still concluding negotiations with partners. So we are launching very soon, hopefully by end of Q3 this year, a $10.5 million fintech lending facility, digital lending facility for micro, small, and medium enterprises. We're piloting out of Kenya, and slowly in the medium term building a Pan-African facility. What we're doing in this is enabling the whole ecosystem of digital lending, one, to reduce collateral pressure on small and medium enterprises. We always have a bias of 30% minimum inclusion on our lending programs to support women and youth-owned businesses. That program will work with 2 fintechs established in the Kenyan market. We will provide liquidity for the demonstration effect through a couple of local banks. But the benefit is that it will fully be uncollateralized lending or unsecured lending. The fintechs will support us to do the market sounding, the screening, the KYC, the onboarding, and the digital scoring. So MSMEs can then borrow up to $20,000 unsecured on account of credit behavior on the platforms. So we leverage the data and look at how we can scale this up to a number of value chains and supply chains within this market and the region, while looking for partnerships across the ecosystem to even crowd in more funding, and hopefully we'll demonstrate to commercial banks and other tier 2 organizations in the sector that lending using digital platforms and leveraging credit behavior can substitute some of the challenges, some of the requirements of lending to MSMEs, and thereby bringing more of these entities into the financial inclusion, but importantly, the financial empowerment sphere. So we're working on on a facility that will take us through Kenya in the next 3 years and hopefully build a five-country Pan-African program in the medium term. I hope that helps to share around our efforts in the fintech space.
Well, thank you. It does highlight, you touched on about 3 questions that were placed in the chat, especially the one on ecosystems. And thank you so much, because you speak to the SME sector. And perhaps I can add on to that in terms of the individuals, because I think Buki said, Africa is a diverse economy. So different countries have different regulations in the financial sector, and ultimately this guides or governs how they engage within the fintech space. So if we think about the East African colleagues, the likes of M-Pesa has been leveraged to at least get more products, such as M-Shwari for credit, M-Kopa, for other products. But they start with M-Pesa for transacting as the foundation, and using, for instance, your record of transacting, you then start qualifying, or you build a credit history, quote unquote, that can be used to provide, to extend credit to you in the new product that is called M-Shwari. And I think what we've seen over the period, again, with East Africa, is the fact that history can be used by the banking sector. So you see individuals progressing from being non-banked to being banked, because now they've understood the dynamics, or the whole practice of credit, what is required. So we can see that individuals migrate from, for instance, using fintech such as M-Pesa or such innovations into the banking sector, which is perhaps what we want. And looking at it that way, the Findex, for instance, data pairs or the surveys show an increasing number of the financially included adults when we compare, or when we combine banks and fintechs. So fintechs are really playing a role here. How does that work? For instance, in the southern region or Southern Africa region, it's going to depend on the regulatory framework, because these fintechs have in many countries, the one challenge that they talk about is the fact that the regulations are slow. Yeah, so innovations seem to be fast enough, but the regulations are then slow, and you don't want to compromise the well-being of the consumers of these financial innovations. So there is, yes, potential for these fintechs, and I can see this open banking. Open banking definitely increases financial inclusion. There's some ongoing work that we're engaged in with the Reserve Bank of South Africa, especially looking at this. And indeed, preliminary results show that there are positive correlations with financial inclusion. Bernard, I'll come back to you. I see a question here to Andrew and perhaps Punke. So they're thanking you for the interventions. What do you think is needed to give, Lord, as I'm reading several questions that are coming in, what is needed to scale, yeah, scalability to the work that you do in providing, this is technical assistance, I believe, blended finance, etc., to SMMEs, and they're asking the question because the sense is that the work you do benefits individual SMMEs, but scalability is needed for that to have a real macro impact in terms of economic growth, job creation, and so on. So to Punke and Andrew, please pick up that if you don't mind.
Okay, no, thanks a lot, Elizabeth. I think that's a fantastic question again. My sense is that, scaling the provision, in particular of, technical assistance and blended, financing to SMMEs, to a large extent, it requires a comprehensive as well as an integrated, approach. So by building, I think, robust infrastructure, and fostering the partnerships, and enhancing also capacity whilst providing access, I think, to markets and, innovating, finance models, can actually be, quite powerful, especially, sharing of best practices in this particular space. And then I think at the same time, this will not only help individual businesses to grow, but to contribute to broader economic development, and the sustainability goals that we are all, I think, chasing after. So if I look at, the approach that ABSA, takes in this space, it's a very much a holistic approach to, some of these issues. And in advancing it, we work quite closely also with stakeholders, in particular, as far as it relates to, getting, projects to bankability all the way through to, the various interactions with regulators, with policymakers, etc. So from that point of view, my sense is that you do need a comprehensive as well as an integrated approach to, this aspect of things. Thank you.
Andrew, do you want to come in? And as you do you also want to say something about SMMEs or MSMEs that also engage in cross-border trade? Is that something that you want to speak to as well? Andrew?
Sure. So I wanted to just mention quickly, on account of some of the cases that I've shared, that we take an ecosystem view and we take a design for scale view in most of our program lending innovations or conceptions. In several cases, we've partnered with COMESA, we've partnered with the COMESA Federation of Women in Business, and we're looking at multiple countries and tens of thousands of women in business. Scale, reaching multiple countries and reaching multiple stakeholders. In the FinTech lending program in Kenya alone, we are targeting enterprises. And that's just on account of our own funding, but the potential to crowd in another 4 to 5 financial institutions means that that number is extrapolated many times as more partners come in on board. Ours is to catalyze the market and demonstrate feasibility or profitability of such innovations so that other partners can come in and sustain the innovations. But again, lastly, when we intermediate through a microfinance institution or a commercial bank, it is very clear from the design that we have to reach a significant number of SMEs, including women and youth. All the microfinance institutions that we've supported over the years have demonstrated significant growth in access and reach or outreach of numbers of SMEs. So hopefully we can scale this up. Of course, the task is much bigger than we can do on our own, but we try and collaborate and partner with others to scale these interventions.
Well, thank you so much to my panelists. I realize that we do not have sufficient time to cover all the questions that are being asked and to dissect the report further. We still had a lot of questions to at least go through, but I believe that the organizers of this webinar will take our questions that haven't been answered, get responses to them, and share with us so that at least we get a better understanding and appreciation of how to actually indeed make finance work for Africa, which is where we want the continent to be. And with that, I'd like to thank you for this fair, and I'd like to hand over to Arnold. Thank you very much to my panelists.
Thank you, Dr. Elizabeth. Thank you for this thoughtful discussion, and I think we learned a lot. And we would like to also thank the audience for attending this webinar. We'll make sure you receive the full report, the presentation, and also the recording within the 3 days. So it was a pleasure to have you here. So thank you again, and see you soon.